No, so historically I've been very bullish on private financials. Structurally, I think it's a great space to be in. But for now, from a cyclical perspective, I think these stocks have run up a bit ahead of expectations. Like when we look at earnings, I look at earnings across Asian banks, and almost in every single market, we are seeing earning upgrades because economic growth is picking up. We have gone through years of slowdown. The only market where we are seeing earning downgrades and consistent earning downgrades is India, because loan growth has been weak. Our expectation is that net interest margins in fiscal 18, if not fiscal 19 also, will be under severe pressure because asset yields are going to go down. And third is credit costs are still going to remain pretty high for the challenge lenders. So in this backdrop, stocks have done very well. Multiples, we look at price to pre-provision profits. And on price to pre-provision profits, most of the Indian banks are trading at like close to all-time high multiples, if not at the all-time high multiples. So in this backdrop, I think next 6 months, 9 months, performance should be challenging. 5 year, 10 years, it's a great sector to be in. But this year, given where the valuations are, we are underweight in an Asian portfolio.
Let's talk about private banks and break it up into the retail end of the bank, HDFCs and the peers, and the corporate banks. How did you analyze the commentary of the managements after the recent earnings season compared to how the stocks have moved? Do you think the market is pricing in a lot of revival already? And overall, what's your stance on the corporate banks versus private retail banks?
No, so we like private retail banks compared to corporate lenders, private corporate lenders, and simply because in the corporate lender space, not just private corporate lenders, for state-owned also, as I said, credit costs will remain elevated for some time because if you look at coverage ratios on NPLs, they're fairly low. They're 35 to 40%. Accounting standards are changing from next year. Indian accounting standard is coming in, which will have an impact on book value. It will have an impact on capital ratios. And one thing which I think market is missing is just the net interest margin trajectory. Asset yields have come down. Interest rates have come down on the new loans. Interest rates have not gone down on the back book. So as we move ahead, I think margins will be under pressure. So those banks, I think from an earnings perspective, will be a challenge. So as I said earlier, earnings are coming down, but for the whole corporate lending space, our estimates are about 20 to 50% below street. So while earnings have come down, we expect material earning revisions downwards over the next couple of years. With the retail lenders, I think earnings are fine. I think consensus is building in the right earnings, at least from our perspective. But valuations are just a bit challenging. So if I have to own them, I'll own the private retail lenders. But generally, everything is expensive.
So the credit growth reading is at a multi-year low. And one pocket of the financials which have benefited most by the low credit growth from the corporate banks and even PSUs is the NBFC space. They have really gone ahead and increased their market share. But at the same time, the street is now talking about a 5 times adjusted price to book as a normal. So the valuation trajectory has really exceeded in our view. And of course, the stocks have done well. Yeah. How are you analyzing the NBFC space, the way they've captured market share versus their valuations now and the opportunity lie ahead?
So I agree, valuations are challenging there also, are very high there also. The only thing is what's happening is, and I mean, that's been the theme from our perspective, again, from the markets also, is the market share game. That state-owned banks, in our view, will not be able to grow for multiple years. There's no capital there. They're not taking provisions. Provisions are relatively light to begin with. So I think for years, our internal capital generation will be weak. And as I said, the accounting standard is changing. So in this backdrop, the market share gain for the private retail lenders, NBFCs, etc., will be quite dramatic. So if you look at the last couple of years, private banks last year, private lenders and NBFCs gained about 500 basis point market share away from state-owned banks. So in this backdrop, the thing about these NBFCs is that the growth can be very, very high. So when people look at price to book, and I'm not saying 5 times book is the right number. It is expensive on the face of it, but you need to look at price to book in the context of 2 things. What is the ROE that the bank is delivering, and what is the terminal growth? Here, actually, ROEs are improving and growth is high. So what market can do, potentially, and again, is that they can keep paying up for these stocks. My view is that, okay, if they're high, the good thing is that because they're compounding, you own them for 6 months. 6 months later, they don't look that expensive.
Right.
And compared to a lot of other financials where there's no compounding. So if I own that stock today and it doesn't do anything for a year, it'll still trade at the same multiple, if not lower, because book values and
so downside is capped and probably a lot of money is hiding there. Yeah. Okay, let's talk about the most discussed place now. And of course, the recent news flow is very high. One of the largest PSU banks recently did a successful capital raising. Others perhaps are still, stuck with their NPA issues versus the need for capital. But at the same time, news flow from Delhi is improving regarding NPA resolution. So 2 questions. One, how do you see measures with the government to improve the NPA situation, one, and the space as a whole? Should institutional investors look there?
So our view has always been that to solve the NPAs, you need 2 things. One is willingness to sell, and second is the ability to sell. The willingness to sell was compromised in the last few months, especially because of concerns around what's the haircut that the banks could take and what can be the potential action from the investigative agencies around why they took those particular haircuts. So I think the process which has been laid down, if more oversight committees are set up, I think that process will be negated. That concern will be negated. But the second thing is the ability to take hits. Like if I am a asset reconstruction company and I come and say that, okay, I want to buy this on a commercial term, I want to make money in IRR or whatever, and I want to buy it at 25, 30 cents to the dollar, I don't think many banks in India have the capacity to sell it at 25, 30 cents to the dollar. Because the coverage ratio on NPLs as a whole that banks are sitting on is 35% for the state-owned banks. Yeah. So what needs to be done is capitalization and a lot of capital. So the good thing is that almost every bank has taken an approval to raise capital. My view would be they should try and raise as much as possible. I mean, the market is liquid. People are giving capital, so they should take advantage of these stock prices and raise capital.
Well, the environment is quite conducive, and that's why probably 15,000 crore issue got oversubscribed, or 25,000 crore.
No, I think large banks, large state-owned banks should have access. I think investors will be willing to invest. The question would be the smaller ones. So, again, given the environment we are in, they might be able to raise capital. They should.
The other hot space for the market in financials has become the insurance space. Not only the appetite for the paper, of course, one is listed, others are in the queue, but also for the sheer growth they are clocking right now, the insurance, private insurers. You look at one, and of course, the entire space. What kind of opportunity do you see for the paper which is lined up, the current stock which is listed, valuations, etc., all of that?
The valuations are high compared to regional peers, clearly, but the thing is, there are not too many insurance stocks listed right now. So in that sense, there's a bit of a scarcity element which is embedded here, and there are more stocks coming in potentially. So that kind of gives a support to the valuations. But then if you look at the underlying growth, also growth has picked up, and our insurance analyst believes that the return on EV is going to move up quite meaningfully over the next 2 to 3 years. So the backdrop is improving ROEV. Improving growth. In that backdrop, I think these multiples should sustain. So we like the space. We like the space.
My last question to you would be not falling directly under the area of your coverage, but since you look at the space, and which is one policy of the government, housing for all. It is for the low income bracket, the tier 2, tier 3 cities, but eventually impacts a lot of financiers. And we are seeing, small companies, mid-cap companies hit the market. AU Finance is coming in the market. Many other companies existing companies are opening branches which will cater to. What is your overall thought for the need for financing in tier 2, tier 3, the India which lives beyond the metros, as an initiative, as somebody who tracks the financial space?
No, I think mortgage to GDP in India is still very low. So what this policy is doing, hopefully over the next 2 to 3 years or 4 years, is that it will just kind of ensure that mortgage growth keeps clocking in at high teens to maybe 20%. So I think it's a great initiative. And plus, I mean, it's a form of capex, right? Because this is an easy form of capex to get going. You will have more demand and supply here. I think it's a great policy. So it should help mortgage growth. Maybe not this year, but in a couple of years, it should start helping mortgage growth pick up quite meaningfully. Now, whether it's banks or NBFCs or the new entities which will gain market share, we need to wait and see, but I think it's a good thing.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.